All right, so we're back from the 4th of July holiday. I hope you all had a great holiday weekend. We actually did something very unique at Market Scholars. We actually had we usually have a Black Friday sale where you get a discount off of our premium subscription. We actually did a July 4th sale where you get a discount off of our monthly subscription. So what we decided to do, you have to be a free subscriber to our site to be able to get that. And you should, and if you are, you should have gotten an email from us with the coupon code. But you get 50% off of our monthly subscription for 3 months. So $150, you get access to all of our trading rooms and our Market Outlook live videos for the next 3 months for $150, and then it renews after that at the regular rate. Of course, you can cancel after any time. But that's something new. We had a great response to it, and so because of the response and because we haven't had a Market Outlook to be able to talk about that until now, I'm going to keep it going through tomorrow, through the end of the day tomorrow, for anybody who's watching this video and wants to take advantage of that deal. The market itself came back from the holiday kind of, again, the same way it kind of went into it. So we're going to break that down and talk about a stock that's breaking down itself and how we can trade it. So let's go ahead and get started. Today is Tuesday, July the 6th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator like we always do. Long lower shadow. Again, long lower shadow is typically bullish, but at the end of bearish runs, right? So in this case, this is the end of a bullish move where they can be bearish. Now, they're not as bearish as long upper shadows, but the bulls did make a good run off of the lows today. That's what produces the long lower shadows. But it does show that for the first day in a while, the bears were at least in the picture, right? You can see all these other days, we're closing at the lows or closing at the highs, coming off the lows. But today, we closed near the high, but with a really significant low. The open was not near the low, which has generally been the case previously. So that hasn't changed the market forecast, so the posture is still strongly bullish. Market sentiment line still above 80, even though it's falling a little bit, still above 80. So we're not close to dropping out of the bullish zone here anytime soon. The near-term line is still easily in the bullish zone for, 11 days now. This 11-day run, the near-term line's been above 50, above 60 for most of that. So, it's in its own bullish run. The momentum line was down. When we were at the lows of the day, the momentum line was at extreme lows. But obviously now not, because we're off of the lows. So when you're above the moving average like this, it's this is the kind of moves you can get because you're so far up above these levels. You can make a run down, and the RSI had hit above 70 on Friday. It's still almost at 70, but that's a pretty high level for the RSI. The trend strength indicator are nearing strong levels. They already are at those levels on the NASDAQ 100, all strongly above 5 and above 80. So we're in very, very strong moves, even if that's not the case for the Russell 2000, which again has broken down a second consecutive day, broken below these lows of a lot of these days, and then now has no trend going whatsoever. If you take a look at its market forecast for the Russell 2000, it's got light pink shading and a yellow line, which is typically bullish. We'll see if that turns out in this case. The near-term peak, this near-term peak on the Russell, was a lower high coming. We already have a new lower low on the near-term level, considering that this is the low point here that corresponds to that level, and now we're obviously lower already. So that's a little bit of, that's a bearish peak to be between 50 and 80 and then corresponding to a lower high. So you wonder if the Russell's going to make a little bit of a move down towards the lower end of this sideways, multi-month sideways channel that it's been in. Otherwise, looking at the NASDAQ, which got a cluster on Friday, an overbought cluster, very strong move. It's very strongly bullish, new high here today, even if, as you saw, I tweeted out here that the NASDAQ here had 31% of its stocks on the composite, mind you. 31% of the stocks advanced today. That's the lowest of all the days that the NASDAQ composite finished with a 52-week high. 1,000 times since 1984. So very, very, very low breadth that we're seeing here. I'll talk more about that here in just a minute. But regardless, it's got a very strong market forecast, and a little bit of a long lower shadow coming off of that cluster. That cluster is a little bit of a concern. The Dow Jones Industrial Average, remember, had about as small and brief of an intermediate pullback that it could possibly have. Didn't even break the 23% retracement level, but it did break 40% on the intermediate line here as we were coming down from a pretty low high. And it was starting to going into expiration before recovering really rapidly the week after expiration. And now you can see its intermediate line crossing back up above 80. So it's kind of back into its own little bullish zone, bullish territory here. Before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also a subscribe button down below the video if you're watching us on YouTube. That will notify you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked your video today. And number two, you want us to do another video again quick tomorrow. Quick way to give us feedback if you like our videos. Of course, if you don't like our videos, you don't have to click on anything. You don't even have to watch. But if you do like our videos and want to let us know, it goes a long way for us. And you can do that with one click right now even while you're watching. Also, comment down there. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching this on our blog here, check out our Market Outlook live video, our trading rooms over here on the right. Our Q&A sessions, remember, are for our premium subscribers. They're including also some of these other tools, a sector selector, the trading rooms registration, where you get emailed with the links for our trading rooms, the trade alerts that you get on your phones. That's all for our premium subscribers as well. Of course, come down here, click on this heart. It opens up a new tab. Hit that like button right there. Also, click on this thumbs up icon. Opens up another new tab. Over here, click on that like button too. Again, the more you do that, the more engagements these posts have, including likes and comments and shares. The more our post gets distributed, right, to people who actually follow us. There's only 72 people saw this particular post, and there's well more than 72 people, like hundreds more than 72 people that follow this page. So again, the more you like it, the more Facebook and Twitter will promote our content to the people who follow us. It benefits you too because they promote content in your timelines from the accounts that you follow and that you engage with. So we try to make it really easy for you to engage with us right here. All right, coming back to our charts, let's take a look at the long-term chart for the SPX. Again, nice, good bullish candle. Remember, the PPO is really high. The PPO hasn't come down at all since the beginning of the year. So, there's been no red arrow on the moving average. That's different than, like, say, the NASDAQ, which has also been bullish. But you notice it's had a couple of periods. The PPO is much lower than it was at the beginning of the year. And then you look at the Dow Jones Industrial Average, and it actually rallied from the beginning of the year. That's the benefit that it's been having. And you can see the brief little pullback it's had here with the small dip in the PPO. And of course, the Russell 2000, which also rallied at the beginning of the year and is way off, about 50% of because it's been so flat, and that 200-day moving average really catching up. Now that 200-day moving average is at the 23% retracement of this COVID move. So if you look at the S&P 500, that's the case now too. The moving average, the 200-day moving average is creeping up to that 23% retracement level. Remember, when you're on a market sentiment run like this, anything between 0 and 23 would be an intermediate pullback. So that's going to be very beneficial in terms of helping us avoid a deeper kind of market sentiment type pullback. Where we would dip potentially down to that 38%. That would be well below the 200-day moving average if that were the case. If you look at the NASDAQ 100, however, here, this will kind of give you a difference here, a different perspective. You can see there's that long-term move. The 200-day moving average is actually below the 23% retracement level by a little bit. So we could have a pretty decent decline and not hit that, whereas that's not necessarily the case on the Russell or the S&P 500, as that S&P is catching up pretty quick. Let's take a look at the 3 green arrow charts. Of course, we got a little bit above average volume. We got 3 green arrows, even if the MACD is rolling over a little bit. This is what it looks like on the 2-line version. You're still easily above the 8-day moving average. The histogram did turn over a little, but the MACD is well above its moving average still. So we're not any kind of threats necessarily of breaking down. I already showed you the RSI. The DMI is not as positive as it was, but still easily above 30, still easy below 20. So we are still in a directional move. We saw that as well on the trend strength indicator. Still a directional move above the dotted lines for both these indicators. So I mean that there's nothing has changed. We're not dropping off a cliff here in the least bit. Obviously, if you take a look at the Bollinger Bands, we're still in the upper quartile as well, well above the value area, well above the one volume node that we have above the value area that will pretty much in the next month or two become the point of control. If you look at the Russell, that is the point of control for the Russell 2000, and that's why we're struggling to get going, because it's there's a lot. The more we trade here, the more gravitational pull it creates, and the bigger gap it creates below that. So we really do not want to break that 213-ish level on the small cap index. But you notice that this dip from Friday, that drop on Friday only got you to the midpoint of the Bollinger Band. With this one got you into the lower quartile. So a little bit of a sign of weakness for the Russell 2000. If you take a look at the RSI and the CCI, you're not quite below negative 100, and you're still between 40 and 60, but you see now we're headed towards the lower end of the range, of the neutral range. If you take a look at the directional movement index for IWM, and you see that's pretty close to a bearish directional play. That's a pretty big jump in the negative directional index. The positive is still slightly above 20. The last time we came close to that, it was right there. So we'll see if we produce this type of bounce tomorrow. If not, if we continue with the weakness in the Russell, then you can see we are building into a bearish trend. If you look at the trend strength, as I said, we were weakly bullish. After really coming close to starting an intermediate run, we didn't, and then we got to a very weak, to the limits of a very weak bullish run up to 50, up to 1, and couldn't quite get even a weak one started, and then now we're back to being bearish. So keep a very, very close eye there on that Russell 2000. All right, now let's take a look at the intraday chart. There we are in the S&P, and again, we filled in that gap, and I talked about this before in our technical analysis class on Friday. Very, very little volume up here. And we're above the value area, which is pretty rare on a 4-week chart with very little volume. So it's very easy to go up and down. As you saw today, we went down and up quite a bit today alone. Now you notice we didn't quite do that on IWM because it's a little different. We're actually below the value area on the Russell 2000. With that breakdown, so that's a pretty significant difference there. If you look at the Qs, you can see the gap that we still haven't filled in on Friday like we did on the S&P. It actually held the gap for support today. So keep that in mind, that we're not quite there yet, and there's still gaps to fill, right? We still can fill in that gap to Thursday. So we're not necessarily out of the woods just because we rallied into the close. But filling in the gap on Thursday wouldn't be the end of the world either. It's not like that would be hugely bearish. It'd be noise, but that's kind of market we're in. It's kind of noisy market with a little bit of a bullish jump to it. I mentioned the volume, a little bit above average, 68 million. The trading range today, if you look at that, the range was 4 points. So if you look at the 4-point range and 68 million shares trading hands, so there's 4 points. So that's above the average, and the ATR is really, really low right now, very low on a relative basis, very, very low. I mean, to an extreme. And then the volume at 68 million. So keep that in mind too, about the volume and the. Because when that volume and the ATR rises, trading ranges rise, those averages rise, that's usually bearish, not bullish. So keep that in mind. If you take a look at the price moves, you can see just how small the SPY and how big the gap is between the implied and historical volatility. Historical volatility is extremely low, as you can see on the chart here. If you look at IWM, it's also pretty extremely low, relatively speaking. These kind of low points, if you look at it, if I give you some perspective on these lows here, this is about the low point for the post-COVID world. Obviously not pre-COVID, but in the post-COVID world, this is the low point, and the same thing on SPY. This is about the low that we've had even pre-COVID. From a historical volatility standpoint, even though implied volatility is still a lot higher than it was pre-COVID. The low point of volatility here is a lot higher than the low point was pre-COVID. If you take a look, as bearish as we were on Friday with volatility, we jumped back up today, but we're still at an extreme low. Still finishing the day around the 80th percentile shows that we're still very extremely low on volatility, and setting up for again, very limited downside when you're this extremely low, and potentially at some point in time, who knows when it would be, but at some point in time, a pop to the upside. That's not going to be tomorrow. It's not going to be this week. But watch for a jump. I mean, we had a jump to the 90 percentile. That got us up to 20. So that's the kind of jump that you can get on a near-term decline nowadays. Not necessarily an intermediate decline, which would get us all the way up here to the 105% mark. It would be probably more of a jump. There's your near-term declines, what they would look like. This would be more of the, remember, this was an intermediate decline on the NASDAQ. This was also an intermediate decline on the NASDAQ as well, and they got up to the high 20s, right? So once we actually do get an intermediate decline on the S&P, look for a move to the high 20s, if not the low 30s, similar to what we got back here when we actually did get our previous intermediate pullback on the S&P 500. So to summarize the technical outlook here, obviously we're still strongly bullish. We're extremely bullish. I mean, that's not a surprise. And there's a lot of extremes and divergences in breadth. And I mean, you're going to see a lot of tweets and things out there about people talking about just how crazy bullish we are. That's the case. I mean, that's obviously the case. That doesn't necessarily mean that we're going to tank, right? It doesn't necessarily mean that we're going to turn around. In the intermediate term, again, we're on a very mature intermediate run that we haven't really exhaled on a broader level. And you're starting to see, as you'll see here in a minute, some other asset classes that are showing signs of risk aversion, even if we're not quite seeing it in equities yet because of the Qs, right? But we, that we're, a risk aversion trade is not going to be, a 2008 sell-off. It's not going to be a COVID type sell-off. It might not even be a 2018 type sell-off, whether it's the beginning or the end. It's just going to be a typical, exhale. It might be a little bit uncomfortable because people aren't used to breathing out right now. I mean, it's like, when you're swimming, you're just used to breathing in all the time, and that's obviously not how things work. So we might be a little uncomfortable if and when that happens, and it's more than likely going to happen sooner rather than later. But in terms of you can see Dietrich has been posting a lot lately. The bullishness we're seeing right now, even if the valuations are extreme and sentiment is extreme and breadth is weak, still we're talking like a year or two maybe of bullishness coming out of this type of move we've seen now. So this is hardly a sign that we are reaching a parabolic top, hardly at all. So don't get the two confused. When I talk about the potential for an exhale, it's not the same as we're heading into a bear market. Not the same at all. Not the same at all. And even as we've seen for the last 6 months, you could have an impending exhale for weeks and months. Even though it's not typical, this has been a very atypical 8-month period. In terms of not having an exhale, because the intermediate runs typically last 1 to 3 months on average before you exhale and you start a new one. So keep that in mind. It's been very atypical, but again, it's just because we expect one doesn't mean that we can't keep going for another week or two into July expiration, which I kind of expect, if we do get one, it won't be a bear market, right? It won't be the end of the world unless you're, vastly over leveraged, which some people might be because they're trying to replicate the type of returns they see in cryptocurrencies and such. But the reality is, it won't be that big of a deal, and we'll set up, a good opportunity, as we've seen in past precedents for this type of bullishness, for really good bullish moves going into another year or two from now. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that suggest why you're either a lot more bullish than I am or a lot more bearish than I am? All right, now let's talk about what's driving the price action today. And let's take a look at, interestingly enough today, the asset classes that had the biggest moves were long-term bonds, real estate, gold, and the dollar. And then QQQ ended up the day relatively strong. But interestingly enough, I mean, the Qs have been a safe haven asset class for the last little bit. We've talked about that before in these videos. These large cap tech names, especially because they've had their own intermediate declines, over during this calendar year that the S&P as a whole has not had. They've been, there you can kind of see here today, even though we had risk off in terms of small cap stocks and other equities down, 1.5% or more, or developed markets down 0.5%, commodities well off. I mean, this is a risk off day, but look, Q's even outpaced bonds, foreign bonds, and high yield bonds here. So it was a very risk off move, and we're seeing more and more of a risk off move. In fact, if you take a look at how things have been performing here, and let me show you from a foreign market perspective. Let's take a look at the 12 biggest economies out there. I mean, look, like the U.S. is the only one with dark green shading and a green line. China is dark pink shading and a red line and falling. Japan is in bearish territories below 40, so a dark pink shading and a red line. Germany is in bearish territory. It's actually in the lower reversal zone. Dark pink shading and red line. Same with Italy. Same with the UK. UK is in bearish territory below the 40th percentile. France, dark pink shading and red line below the 40th percentile. Some of these others that aren't quite as bearish are working their way in that direction. India, light pink shading and yellow line, falling below 50. Korea, not as bullish as it was. Canada, not as bullish as it was. But falling below 50 on its intermediate line with a yellow line, and Brazil really breaking down here. So I mean, that's a pretty significant divergence here in terms of the largest economies in the world and the equities from those particular markets. And then you look at stuff like long-term bonds, the longest of long-term bonds. Strong bullish trend. Market sentiment lines falling across up above 50, about to cross above 60 for the first time in a long time. Again, market sentiment doesn't get above 60 when the markets are in bull markets, like when risk appetite is bullish. You take a look at the Euro US dollar, and you see that the dollar continues to rally with some weakness in the euro. Strongly bearish near-term peaks well below the moving average. And today, with the dollar rallying, gold actually rallied too, off of its highs of the day, but still rallied up. Gold has been bearish because of the strength in the dollar, but when those two go together, as you can see, their correlation typically is pretty negative with each other. Makes sense because gold is actually, this ETF is actually denominated in dollars. But you can see it typically doesn't have here, let me change the correlation here to let's see, UUP. This is the bullish dollar ETF. You can see it's pretty negative, but there are times where it can be positive, right? And you can see it was positive at the end of the year briefly, gold and the dollar. It was positive in 2019. The fourth quarter of 2018, when things kind of hit the fan, it was positive there. There's the COVID low point. Things are rallied up here. And again, remember there, September and October, there was an intermediate decline. In this case, gold and the dollar both went down as a positive correlation rallied with very strong risk appetite there. And now you can see gold and the dollar back in opposite. That's very, very typical. But if you take a look at a smaller time frame, this is over a quarterly schedule, of course. But if we take a look over just the last 2 weeks, you can see the correlation is positive. And it's the highest positive correlation we've had since that October peak when things were dropping. In this case, they're actually both rising. So the correlations, when those two go together and we're going to the upside, that's a sign of risk aversion, not necessarily of risk appetite. Now let's take a look at the 12 grid here, and you can see that if I click on, or not the 12 grid, the sectors and how the sectors are performing. If we, again, just take a look at today alone and see how things have gone today. You can see it was a risk-off move, and by the end of the day, you had utilities and real estate. That's not surprising, but but again, technology and discretionary holding up very well on a risk-off day. And you can see where the risk was being taken off. It was in energy and financials and materials and industrials. Those are the areas of the market we've talked about that would have the biggest losses if they were to start rolling over. And you can see they are rolling over. They look, dark pink shading and red lines. The only dark green shading and green lines are in these areas that are showing clusters and extreme levels above their moving averages. Real estate starting to ramp up a little bit too. It's a little bit of a inflation type trade, and healthcare looking relatively bullish, but staples and utilities, dark pink shading and a red line. So not really the most bullish type platform, except for, again, in one singular area here in the market. If you take a look at how the rotation is occurring here, let's go back to the sectors and just look at it for the daily chart. Interestingly enough, materials, financials, industrials had been doing, and energy had been doing relatively well. Now keep in mind, take that with a grain of salt, because like, for example, here's energy, and here's the daily chart. Energy had, it appears to be diverging a little bit. You can see here, if I just go to like a 1-year daily chart, the relative strength peaks are getting smaller as we get higher highs. Like, that was our biggest peak in March 15th. We've gotten higher highs since then with much lower peaks. And now we're below 100 on there. And materials, you can see the same thing. Like, materials relative strength peaked way over here, and it's rolling over, relatively speaking, compared to SPY, and and you can see the momentum lines starting to roll over too. Industrials, you can see, has had some positive momentum, but it also appears to be rolling over now with weak relative strength coming off of that divergence of relative strength. And then financials, also a divergence here coming off that mid-March peak, higher highs with a lower high in the relative strength. It's got negative, and you can see we've had some positive momentum, but it appears that that momentum may be stalling, especially with how things are rolling over on a lot of these charts. So they've had a good run in the last 2 weeks or so. These sectors they've had some relative positive momentum, but not enough to give them positive relative strength. And you would expect that they would continue to show weakness with these rollovers, and that's, again, they're the ones that have the most to lose right now, because they've had the tremendous gains going into that March. If I were to show this peak here, this chart sector comparison, if I were to go off of that September 24th low point when the Russell 2000 started this run all the way to that March 15th peak, here you can see energy and financials, materials, industrials, they had a really, really good run. And then go to that mid-May peak where we had a divergent high point on a lot of these areas. Let's go to May 14th. You can see there's that divergent high point in a lot of these areas. They still had a very good returns, 40% over the course of, 6-7 months or so. 60 and 70% for financials and industrials. Whereas technology and discretionary, you can see down here at 20% returns, less than the broader market as a whole. So you can see how they can act as a safe haven because they're down there with the other safe havens, whereas these other areas are the ones that have the most to lose right now. That brings me to our trade idea of the day. I want to take a look at Wynn Resorts. Wynn Resorts is kind of breaking down here, breaking below some lows today. Yes, we got a little bit of a bearish cluster, but you can see its market sentiment line is falling below 40. Its intermediate posture strongly bearish. If you take a look at the 3 green arrow charts for Wynn Resorts, we are starting to diverge to the downside on the MACD. And if I were to go to a PPO here to kind of give you an idea of how far down we can go before we hit extreme lows on the downside. So let's change this to 8 and 17. and take a look at that there. So, and let's go like 5 years. So to kind of give you an idea, we can go up. It looks like the limit to the upside is about 4.25% in the past. So that means to the downside, we could get down to about 4.25%. You can see that hasn't been the case, and we're pretty low now, but we can go down even lower as we've seen in the past during any kind of periods of weakness, especially with the stochastics itself down below 40. If I look at the weekly chart for this. For the MACD, it's just barely starting to cross zero. The PPO, it's just barely starting to cross zero as we're crossing below the 30-week simple moving average. And then you can see the stochastics and its moving average crossing below 40 here as well. So kind of in bearish territory. If you look at the DMI for Wynn Resorts, we are getting a directional move above 30, below 20. With the ADX, it's got a lot of room to go. If you take a look at the RSI and the CCI, you can see we are breaking below 40 and below negative 100 on the CCI. If you take a look at its trend strength indicators, you can see the trend is strengthening. We are below 2. We broke below 2. We broke above 65. So we are starting a bearish intermediate trend according to that indicator, well below the cloud. So, you know, we've got the potential for a bearish run going on here, especially with, if you look at the long-term chart for when we are breaking below the 50-day moving average and working our way down. Now, granted, how much further down can we go? I didn't show the Bollinger Bands. I think you can see we are breaking below the lower band. How much further down can we go? Well, there's going to be some support in this area at the 200-day moving average and that volume node, and there's some significant resistance above us. So that sets me up for saying, okay, well, let's take a look at doing a bear call spread where I sell the mid-30s delta, buy one strike away. Again, we have to worry about earnings, so keep that in mind. Get rid of this here. So I've got a normal risk going for about a $369 reward. If you see where my break-evens end up being, if I put my break-even here and set it to the chart, it's above those highs, so it's above that volume node. So we'd have to be a significant bullish move for us to lose $369, which is what I'm willing to lose out of that 1,100 that we have our risk there. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forum on our website. All of our subscribers have access to that forum, even our free subscribers. So post any new threads there with any questions or comments you have. Reply to anybody else's questions or comments. And let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Like us on Twitter and Facebook as well. Comment on the video. Have a great rest of your Tuesday night, everybody, and we'll see you all tomorrow.